Hello. Yes, I think I'm audible. Um, Welcome, guys. Welcome back. I am Paritosh Panchal. I hope you have seen day one. Um, so my voice is a little off today, so please excuse me. Uh, but let's continue with our revision. I hope you have watched the day one video first, wherein we have discussed certain tips and tricks for the exam, certain important pointers. Today, as promised, we'll be discussing a topic and we'll do some questions based on the topic, a section C sort of question, right? So, we are going to discuss working capital, and within working capital, we are going to discuss accounts receivable. Right. See, in working capital, there are various different types of working capital. As in components to working capital, there is current assets. Within current assets, you have your receivables. Okay, you have inventory, you have cash, and then in payables, that is, sorry, your liability, you have your payables. Right. These are the major components. There is also outstanding bills to be paid. That would be a part of your current liability, or something paid in advance. That will be a part of your current asset. So all those are also there, right? So within FM, I'm sure you have studied each component properly, and also we had the cash conversion. Sorry, the cash conversion cycle, which tells us that within how many days do we get our money back, because current assets usually have a tendency to tie capital, in the sense that, say for example, if you have inventory, okay, inventory is not sold yet, so you have not received any money. However, to purchase the inventory, money has gone out. Okay, money is tied, right? Similarly for receivables, you made a credit sales, you are yet to receive the money. However, in your P&L, you have recorded it as sales. Okay. But did you get the cash yet? No. So there is no cash inflow. It's tying up your cash, right? So what are accounts receivables? Accounts receivables is basically your customers who are yet to pay you money. Why are they yet to pay you money? Because you have given them a credit period, right? So normally in business, um, say you have made a sale of, say, some books, right? Now, you may not get the money immediately. You have given, say, 2 months credit. So you tell your customers it is okay, you can pay me after 2 months, right? Here, take the books, I'll deliver it to you now. Okay. Why do we give this credit? It is business norm. It's just general business. Like all our competition is doing it, we are also doing it. So the industry, it's very normal in the industry to give 1 or 2 months of credit. Now, this would vary from industry to industry, sector to sector. Okay, so there is certain, like say for example, retail. Retail is not known for giving credit. Like when we go to a supermarket and we buy groceries, they never give us credit period, right? They don't say us, okay, take 1 month, you pay later. However, those very same supermarkets, when they procure those goods from the manufacturer or the distributor, they demand for a credit period. They would have probably 1 month of credit period available with them. That means they will purchase the grocery, right? Say for example, uh, clothes. Okay, let's take it that way. So the clothes are being purchased. Say t-shirts are purchased from the distributor or the manufacturer by the store. Okay, and the store gets 1 month credit period. Within this 1 month, the store will try its best. So when it's in the store, it's an inventory, and this inventory will eventually get sold to the customers, right? And the customer will pay immediately, right? So the customer does not get any credit period, but the store got a 1 month credit period. So for the manufacturer or the distributor, that store is an account receivable. They sent the t-shirts. In their books, they have recorded a sale, but did they get the money? No, right? So that's accounts receivables. Now, there's in working capital, we are trying to understand how to manage these receivables, right? How to ensure that they pay on time, how much credit period to be given, how much credit is to be given. How do we know whether we should give them 1 month credit or 1.5 month credit or 2 months credit? How do we know we should sell goods up to $1 million or a $2 million to this particular person? How do we collect that money on time? What are the follow up steps or procedures we have to do? How do we select that this customer we can give credit, this customer we shouldn't give credit? All this constitutes a part of working capital management. Sorry, receivables management. Okay, so receivables management is concerned with calculating the optimum credit period allowed to the customer such that profits are earned on an incremental sales due to extended credit period is more than the cost of maintaining or funding the investments in accounts receivables. So understand when you have to figure out that how much credit should I give to this person. Now, firstly, what is the need to give a credit? What if you do not give credit? Let us take an example. You are one manufacturer of t-shirts, okay, and there is another competition. The competition is giving 1 month of credit. You on the other hand decide that no, sorry, I'm not going to give credit. The store will obviously want to do business with your competition, because why? From the store's point of view, they have to pay money but not now, a little later. Okay, so they would always prefer paying that money a little later so that it doesn't affect their liquidity. Their liquidity is in a better position. But our liquidity gets compromised in that, right? However, they are compromising their liquidity, but what are they earning? What are they getting in return? They are getting profitability because they are making the sale. We are not able to make that sale because we are preferring liquidity. They prefer profitability. They are making the sale. They are earning that profit, sacrificing their liquidity. We have sacrificed our profitability but are maintaining liquidity. So we need to balance it out. It can't be zero, it can't be 1 year, right? There needs to be a balance. It should be a cost benefit analysis that we need to do to figure out that, okay, we can sacrifice this much liquidity, okay, but on sacrificing this liquidity, benefits are more. That is, the profitability is more. And now, say, for example, if we sacrifice this liquidity, okay, say, for example, we sell t-shirts worth $1 million. We are going to get this $1 million after 1 month, right? So for 1 month, we do not have $1 million, but we have salaries to be paid. We have rent to be paid. So we need liquidity. We need that 1 million. So how are we going to arrange for this 1 million? Most probably we can take a overdraft from the bank or a short-term 1 month loan from a bank. What is the difference between an overdraft and a loan? Well, in case of an overdraft, it's over treat an overdraft like your credit card. Now don't go saying this out that it's a credit card, but the concepts are similar, right? In a credit card, you have a limit. Similarly, in an overdraft, you have a limit. Say, for example, your limit is $5 million. Overdraft limit is $5 million, and you have drawn just $1 million out of that 5 million limit that you have. So the interest you will have to pay is only and only on that $1 million. If you take a 1 month loan and if it's a $2 million loan, then you have to pay interest on that entire $2 million, whether you utilize it or not, right? So when it comes to overdrafts, only what you utilize, that much you have to pay for, right? So you arrange for $1 million for that 1 month through an overdraft facility. So that is the cost of your funding that receivables. So you need to see that the funding cost is less than the profit that you are earning. If profits are more than the cost, then yes, go ahead with that credit, extend that credit. If it is not, then you would say, sorry, I cannot give that sort of credit. Okay, because now, say for example, the interest for 1 month is less than an interest for 2 months, right? So the cost for funding 2 months will become more. So you will see whether that's still beneficial or not, or the costs are taking over the benefits. Then in that case, you will say, sorry, 2 months is not possible. I can do 1 month because for 1 month, it's more beneficial for me. 2 months, my costs are more than that. So it doesn't make sense for that incremental sales. Say, for example, you are giving credit for a month, okay? But your customer is demanding more, probably saying that the competition is giving more. You would say, sorry, it's not profitable for me. Or you would just say that, sorry, these are not the terms that I would work on. So that sale will go, right? So you have to see that sale loss is more loss making or costs you more, or does that funding cost you more, right? If the funding costs you more, then you will say, sorry, let that sale go, no problem, because my funding cost is more. So there was no benefit that I would accrue out of it, right? So, like in every component of working capital, there is always a liquidity and profitability that you need to balance out. Okay, so um if you are collecting sales quickly, sales received as quickly as possible to reduce the cost of financing the receivable balance, that is, you are prioritizing liquidity. Whereas if you are extending the credit period to the customer to encourage additional sales, then you are focusing on profitability. But there should be a balance of the two. You can't go in either extremes, right? Now, factors influencing companies' credit policy. So, what are the factors that you will consider before giving or before deciding how much credit to give and for what period? So, one of the things you would want to look at is, say, the credit rating of that particular company. Okay. If the credit rating is good, then you would be able to give a, a decent, that, okay, it's a AAA rated company. Um, so it won't take become into a bad debt. There's a less probability of it, so you could give that person credit. You could be governed by the competition or the industry. What is the industry norm, right? If the industry norm is 2 months, you are forced to give 2 months credit. And if you're giving less, then why would you need to incentivize? You may want to give an early payment discount to your customer. Only then will the customer be incentivized to do business with you, right? So the competition's firm terms is another factor that would influence your policy. Demand for the product. See, if the demand for the product is more, you know that even if you lose a couple of sales, there will be more people because there's so much demand for it. So even if your competition is giving 1.5 months of credit, you are giving 1 month of credit with maybe a little bit better rates. Due to the demand, probably you will not end up losing that much sales. So you can sustain that 1 month. And the other factor is financing cost. If your cost of funding those receivables is too high, then accordingly you will decide how much period you can offer, right? Cost of credit control, that um, see, when you have to give credit, you need to control this credit in the sense that you have to hire people to do the credit assessment, to come up with these policies, to follow up with them that, hello, you have to make your payment. Like, say, for example, you have given a 1 month credit. Now, after 25 days, you will send an email to that person, just a reminder that you need to pay your money in 5 days' time, in 2 days' time, 1 day time. Okay, then on the day or 1 day prior, you would call up with the person and say that, hey, you have to make the payment How are you going to make it? Should I send someone to collect the payment, or are you going to do an online transfer? How are you going to pay? Right? So all that follow up needs to be done. And for that, there is a person involved for giving credit and or determining the policy, the credit policy. There is another person hired. So all this is a cost, right? So that constitutes cost of credit control. Then the risk of irrecoverable debts or bad debts. What if the person doesn't pay, right? That's a risk. You don't get that money. So you have given a 1 month credit and the person says that, you know what, I don't have the money. I have only 50%. So I can only pay you $500,000. The other $500,000 is bad debt. Okay. You could file a case and all of that, but if they don't have the money, you're not going to recover anything out of that account, right? If they genuinely don't have the money. So that is the risk of irrecoverable debts. So all these things are going to constitute your or are factors that is going to influence your credit policy. Now, what are the elements within the credit policy, right? First off, the basics are written that how much credit we'll give, what amount of credit we are ready to, or say for example, there's a store that you're doing business. You would say maximum I can give you is $1 million worth of goods. Okay, $1 million worth of t-shirts. I cannot give you a credit more than $1 million. I will never supply you goods of $1.5 million. If you want $1.5 million, you pay me 500,000 first, and then I'll provide you with 1 million credit. So that becomes a total of 1.5 that way. Okay. So how much months? Say 1 month or 30 days or 35 days, 45 days, whatever the period is mentioned. The amount that we would give is mentioned. If you pay early, then what sort of discounts, and define that early. If you pay within the next 1 week, then I'm willing to give you say 2% discount. Okay, all of that is mentioned in your credit policy. And then if there is any delay, right, if the stipulated time you have to pay in is 30 days, if you pay after 30 days, are you going to attract any interest, right? Um, so all those things are mentioned in the credit policy. So establishing the terms of trade, like the period of credit offered, early settlement discounts, etc. Will interest be charged on delayed payments beyond a credit period? That is, once it becomes overdue. Establishing the procedure to be followed when granting credit to the new customers. So the policy would also have certain criteria like tick boxes. Okay, does this person has X amount of turnover? Yes, if it has, so we know that okay, they are doing big business. So, and since they are doing big business, they are dealing with multiple people. Now, if they are paying those people on time, that means there's a high likelihood we are getting paid on time as well, right? So, do they have a certain turnover? Do they have a certain credit rating? Do they have a certain goodwill? Right? So, what are the checks that you're going to have? So, the procedure that you would follow when giving credit to any new customer, and establishing procedures to be followed when accounts become overdue. Once it becomes overdue, do you send a mail? Do you call them up? What is that procedure to collect these accounts? Right? Now, credit analysis. How do you analyze uh, how much credit is to be given? Credit worthiness, you are basically checking. So you need to check the credit worthiness of all the customers, all new customers, and existing customers probably periodically, because initially you already took their worthiness check. Probably after a year, you would want to do it again just to ensure that they are still worthy enough to get the sort of credit you are extending and the time that you are giving them, credit period. The depth of credit analysis depends on the amount of credit being granted as well as the possibility of repeat business. See, if the customer is there's a possibility that they are going to do business only one time, then there is no point doing all this credit worthy assessment of credit worthiness, because all of this comes at a cost, right? So you would say it's just one time, it's fine. Okay. Or if the amount is small, if it's just $100, you're not going to bother. You would say that, okay, you want $100, you want 1 week to pay it, take it. Take 1 week, no problem. Because it's a small amount, right? But if it's $1 million, you would want to do more checks. So where will you get that information from? From banks. You could speak to the banker that are they paying interests on time? What sort of, do they have decent liquidity? You could ask other vendors in the, so trade references, right? You could ask other vendors. Say, for example, you could speak to their employees if they are getting salaries on time. You could speak to, now say for example, if you are providing the t-shirts only, okay, now maybe that store is also selling certain leather jackets. You are providing cotton t-shirts, so there is someone providing, say, shoes in that store, or leather jackets in that store. So these are trade references. You are talking to other people that how is it to do business with this person? Are you getting your money on time? Published informations like your statement of, so your P&L statement, your balance sheet, all of that is published information. It's public information, right? Certain companies which are not listed, you can still, they are public information in the sense that you have to pay the, there's one institute, like, so for in India, it's Ministry of Corporate Affairs maintains all these accounts. So you just a very nominal fee to them, and you can get the details of any company, listed or unlisted. Okay, company sales record, as I gave you an example previously, the turnover, how much sales are they doing? Credit reference agencies like your AAA, like as in you have Standard and Poor, you have Fitch, you have Moody. Okay, they give credit rating. So credit reference agencies and credit scores, so you would seek information from there, or your competition also. See, many times you feel that competitors are basically enemies. No, in most cases, competitors are friends, because the market is big enough for them to serve. You would often realize that when you go, say, for example, you want to buy jewelry, you'll find many jewelry stores next to each other, right? And most of these people are friends amongst themselves. Everybody is doing business, everybody is doing well, everybody has their own uniqueness, okay, their own USPs. So they are all friends. So they share information also within amongst themselves. Okay. Or it could not necessarily be your competitor, it could be some other vendor. Like if you look at it from a restaurant point of view, okay, a restaurant will buy buns, so there is a vendor for bun. It would buy vegetables, there is a vendor for vegetables. It would buy other condiments like cheese and etc. So they have a vendor for that. They have a vendor for vegetables. Okay, so there are several vendors. These vendors can talk amongst themselves and figure out that whether this person gives money on time or not. So you can, based on that information, decide how much is this person worthy of giving credit. Okay, how much amount and what period, right? Based on credit analysis, certain credit limits may be set for each customer, and once the limit has been reached, no further goods are sold to the customer. Credit limit should be set to reflect the amount of credit available and the time period after which the payment becomes due. So both you have to define how much amount and the period. Sales made on credit to customers need to be monitored to ensure that the individual customers' credit limits are not breached. You need to have someone who's continuously monitoring how much. Now, say for example, you have decided that maximum exposure or the maximum I can give on credit is $1 million. Okay. Now, this customer last time purchased goods worth 75,000, $750,000. Okay. So that means that I can now only supply $250,000 worth of good unless I get any cash. And this customer calls me up and says, please send more $500,000 worth of goods. I'll say, sorry, can't do it. Maximum I can send is 250. You would give some excuse to him, or you would just say, be very transparent, saying that, the maximum credit I am able to give you is $1 million. So if you want to purchase further goods of $500,000, you need to make some payment of the past goods that I had sent. Okay. So you need to monitor it. Company needs to ensure proper invoices are raised and sent to the customer on time, as credit period only begins once an invoice is received. So you need to ensure that you have a proper person generating invoices on time and submitting that invoice to the customer. So ideally, with the goods being sent, you would send that invoice. The invoice may be created on a different date. So you mention that date. Okay, probably the invoice is created today, got delivered tomorrow. The date of the invoice is today's. So from today, it will be 30 days, not from the date where the person received the goods, right? Excuse me. Ah, I hope my voice is clear. I'm really struggling. Um, Anyways, coming back, risk of default and bad debt increase if gets overdue. Okay, so you need to be aware as to what if it becomes bad debt, or what are the chances of it becoming bad debt. You should have a system that will try. So you should try your best that it doesn't turn into bad debts. How do you do it? Continuously remind that person that, hey, listen, you have to pay, or send an email or a message. If you, I don't know how many of you are driving, but if you are driving and you have an insurance, probably 1 month before the insurance expires, you will start getting emails, messages, calls, continuously reminding you that you have to renew your insurance, renew your insurance. Similarly, 1 week prior, you can start calling the customer. You have to make the payment, you have to make the payment, you have to make the payment, or send emails. Okay. Probably, the due date has gone. You could pay a personal visit. Hey, listen, you were supposed to pay yesterday. What happened? Right? You could penalize the person by saying, I'm going to charge interest if you do not pay me on time. Okay. So at least out of that, they would say, okay, even if they delay, they will have to pay more. It's kind of like they have taken a loan from you then. Okay, so they would say, okay, I don't want to pay any interest on any amount, so let me just pay in the stipulated. Other thing you can do is just stop supplying them. Because, say, for example, you have given a customer 1 month of credit and within 1 month they haven't paid, then you are not going to give them any further goods, because you will say, first, pay me my money back, which was due already. See, all these steps are taken only once it becomes due, right? Then still you're not getting your money, appoint debt collectors. They are specialized people who knows their ways. They have their means to recover their money. Okay, so you could hire them. And last, see, legal actions cost a lot of money, it takes a lot of time and resources. So that's the last resort. You do not go legal first, right? You try all the other steps first, still no solution, then last resort, you take legal action. With any action, the potential benefit should always exceed the expected cost. Because see, if you need to have an auto system wherein it sends emails, okay, as reminders, right? That system will come at a cost. If you have to send someone to collect the money, that someone is going to ask some fees or ask a salary, right? So if you hire a debt collector or whatever, if you refuse to provide goods, that's or sale loss. So everything has a cost. So again, the benefit should be more than the cost. Only then would you go ahead with that. Once credit has been granted, it is important to review outstanding accounts on a regular basis so overdue accounts can be identified and corrective actions can be taken. It is very important that you monitor these accounts receivable because, see, the customer from front is never going to pay, right? Like just think of it. The customer has to pay you in a month's time. If if you do not remind him, they're not going to pay you on time. They would say that person is not bothered. No, I have the money, but until and unless they don't ask me, why should I pay? Let me keep that money in my bank. Let me put it in some deposit, invest it somewhere, earn some returns out of it. When they ask, I'll pay within the 1 2 days. I'll just liquidate that investment and pay. Right? But if you don't ask, why would they pay on time? You need to have someone who is analyzing this. Or else what is going to happen? He won't pay and you didn't bother. Now, after probably 1.5 months, he wants goods. And that's when you realize, oh, he didn't pay the last bill. And you would say, okay, I will give you new goods, but you need to pay for the last bill. Well, yeah, oh yeah, I sorry, it missed my mind. I'll just pay it right up front. So basically, the money that you were to receive within 1 month, you received in 1.5 months. For a simple reason that you were not reviewing or monitoring your receivables, right? So monitor it. You can do it with the help of age analysis. Basically, you are monitor tracking the age of different creditors. You can do it through certain ratios, like your current asset ratio. Um, you could do it through simple statistical data, wherein you are just collecting data and a very simple system wherein you are just probably you have an automated system wherein you write that the name of the customer, the amount granted, okay, and credit period given and the start date, and automatically the system will only send you a reminder, right? Now, as we discussed initially, that these receivables need to be funded eventually. Because if you're giving $1 million as credit for a month, then for a month you may have a requirement to pay money elsewhere. Okay, you need that $1 million. So what will you do? You will take an overdraft facility. Okay, so say for example, you are away, like you are to receive $1 million after a month. So you are basically taking an overdraft of $1 million, and on that $1 million, you have to pay some interest, the overdraft rate. That is your cost. Now, how do you know how much is the receivables? You will take your credit sales into receivable days divided by 365. This is nothing. We typically use the same formula for receivable days, wherein receivable days is equal to receivable balance divided by credit sales or the relevant cash flow. In this case, it's credit sales into 365 to get the receivable days. So it's just a rearrangement of that formula. Keep in mind, this formula is not given in the exam, so you need to know this formula, right? So again, it's the same formula, it's just rearrangement. Whether you remember receivable days formula or you remember receivable balance, the same thing, just rearranged, right? So in this case, receivable balance is equal to credit sales, which will be given in the exam, into receivable days will be given divided by 365. So you can get why 365, because receivables are in days. Had it been in weeks, you would do divided by 52 weeks or 50 weeks. It will be given in the exam. If nothing is given, you can assume a 52 week. Okay. Or it could be in months, 12 months. Say receivable month is 1 month, then it will be 1 divided by 12. Say if it is 3 weeks, then it will be 3 divided by 52, right? So that's your finance cost. Okay. Now, if you want liquidity, right? If you want the money early, so why would your customer pay you early? probably if you offer some discount, they would get incentivized by it and they would say, okay, I don't mind paying your money early. Like, I don't want 1 month, I'll pay you within a week. But what's in it for me? So you will say, I'll give you 2% discount. Like, okay, fine. Then I'm willing to pay within a week. Now, how do you know that whether you should offer a discount or not? Again, cost benefit analysis, right? So you will try to understand that if I am giving a discount, that means I'm losing some money. Like, say, for example, I was to receive $100, but I gave 2% discount. So now I'm receiving only $98. Okay, so $2 is my cost for that discount. Okay, but what are the benefits against it? Well, I'm getting my money quicker. Since I'm getting my money quicker, I do not have to take an overdraft facility and pay 7% to my banker. Otherwise, if we would have taken, say, 1 month, I would have to take an overdraft facility for a month. But now I'm taking overdraft facility only for 3 weeks because he's paying within 1 week. So I'm not taking for 4 weeks, I'm just taking it for 3 weeks, right? Or to make things simpler, days. Say if you're giving 30 days credit period, but if the customer is paying within, say, 5 days, okay, then you need not take overdraft facility for all 30 days. You will take overdraft facility only for 5 days, and you are saving on the balance 25 days interest. So that is your one of your biggest savings. So you will try to compare, is my saving or benefit more than the cost of that discount, right? So if you remember in day one, we had seen one example question where overdraft rate was given and we were asked to, we were given information about discount, wherein we calculated the annual cost of the discount. Okay, so this is the formula. Wait, this is the formula. 1 plus the discount divided by amount paid after the discount. So say for example, if the discount is 5%, then it will be 5 divided by 95. Okay, raised to number of period. Now, what was that number of period? You will take whatever 365 days or 52 weeks or 12 months divided by number of days, weeks, months earlier the money is paid, not the entire credit period. So, if you are extending a 30-day credit period and the payment is done within 10 days, you will do 30 minus 10, that is 20 days. It's paid 20 days earlier. So, 365 divided by 20. Right, this is the cost of discount, annual cost of discount. So you will compare the annual cost of discount with the overdraft and you will say which is more beneficial, right? So other benefits includes reduction in receivables, shorter collection period. Since the collection period shortens, you have to pay less interest, your funding cost drops basically. So decrease in financing cost, the interest that you are saving, decrease in irrecoverable debt, lesser risk of bad debts or lesser amount of bad debts. All these are benefits of offering a discount, right? So the cost is just the cost of discount, how much you are getting less. If you're giving 5% as a discount on $100 item, you are giving $5 off. That means you are receiving only 95, so your cost is $5. Okay, so if a discount is not availed by the customer, then incremental costs, increase in financing costs, and increase in irrecoverable debt. Okay, that means if they do not take a discount, then your cost of funding it and your risk of irrecoverable debt is there. Okay, but if they are funding, they are taking the discount, then you have one cost, that is annual cost of discount, which is equal to 1 plus the discount divided by amount paid after discount raised to number of period minus 1. Right? This is the formula. Just keep that in mind. Yesterday they used another formula. Anything you use, you will get the same answer. We prefer this formula in our classes. Okay, so follow this. Right? Please note that the annual cost calculation is always based on the amount left to be paid after deducting discount. That is the amount net of discounts. That is, you will take 5 divided by 95, not 5 divided by 100, right? So if our annual cost of discount is less than the overdraft interest rate, which is saved, then give the early, it gives you basically the early settlement discount. That is, when benefits are greater than the cost, then the discount should be offered. Obviously, right? If your cost of discount is less than the overdraft, you will offer the discount. Now, remember this, we are thinking from a supplier's point of view. We are thinking from a vendor's point of view. We are considering whether to give discount or not. Similarly, the exact opposite is done by the customer. The customer will decide whether they have to take the discount or not. Okay. So what is our cost? Annual cost of discount is basically their benefit for the discount. Okay. Now, if any portion of the customer avails the early settlement discount, then calculation involves comparing. You have to compare the cost and benefit. The cost of offering the discount in monetary terms, that is the cash that will no longer be received, that's the cost, with the benefit that you're enjoying, that is lower financing costs resulting from funding a reduced receivable balance. Okay, lesser overdraft required and interest paid on that overdraft. Calculate the existing receivables and receivable days with no discount. So these are the steps that you would follow when you have to find out whether early settlement discounts are to be offered or not. So firstly, you will calculate the existing without any discount. What are the receivables? What are the receivable days? What is the cost to fund these receivables? Okay. And then you will calculate the new receivable days, new receivables and the new receivable days. Okay. And find out the cost of funding that new level. And then compare whether the old was better or new in the sense after giving discount, if that is better. So compare the old cost with the new cost to determine the benefit and check if the benefits is greater than the discount offered in monetary terms, right? Now moving on, invoice discounting. Now don't get confused with regular discounting. This is slightly different. And this is a method of funding, not basically giving discounts per se. But what you do is you take an invoice. Say, for example, you have sold t-shirts worth $1 million, and you offered them a discount, but they are not taking that discount. They said, sorry, we don't want it, not interested. Okay. Now you need money. One way of taking that money is through overdraft facility. But say, for example, you don't want that overdraft facility, right? You can approach someone called who's known as a discounting agent or an invoice discounting agent and tell that person that, hey, listen, here is a bill, okay, an invoice of $1 million. Clearly in the invoice, it is mentioned that I am going to receive $1 million after 1 month, but I need the money now. So take this. Can you give me money in return? Okay. So that person says, all right, but I won't pay you entire $1 million. There will be a haircut of 20%. So I can fund you 80%. You say, fair enough. So you will get $800,000 and you have to pay an interest on that $800,000. Okay. So invoice financing or discounting is a way to monetize your company's outstanding invoices. Invoice discounting enables businesses to gain instant access to cash tied up in unpaid invoices. The key advantage of invoice discounting is that it is a confidential service and the customer need not know about it. So see, customer need not bother that what you do with that invoice. Okay. Customer would never know whether you discounted that invoice or you did not, because the discounting agent is never going to approach the customer saying that, hey, your time's up, you have to pay. That all that you still have to do. The invoice discounting agent is just going to provide you with finance. That's it. End of story. After a month, that agent is going to call us not our customer, saying that, hey, listen, a month is up, you have to pay that $800,000 which I gave to you earlier back. Okay. So this is just a graphical representation wherein the company sells certain goods to the customer. The company will go to the agent, get 80% as loan. Okay, that's step number 2. Step number 3, the customer pays the company, and step number 4, the company repays the discounting agent, whatever amount borrowed plus interest. Now, there's something also known as factoring. Okay, factoring is a little more offers a little more services. So they not only give financing, but they also probably can take over the administration part of it, especially useful for small companies who don't have the bandwidth to have separate people to monitor credit, to decide or to do credit worthiness checks, all of it. So it's kind of like outsourced to a factoring agent. Okay. So invoice discounting is a loan secured against outstanding invoice, and invoice factoring companies actually purchase those invoices outright. So factoring companies gain credit control, which enables them to deal with the customer directly. Factoring is the outsourcing of credit control department to a third party. So now this factoring agent will do everything, will deal with the customer, will send the reminders. All of that is done by the factoring agent. So all those credit control services, okay. So you need not hire anyone as an employee in your company. You have outsourced that thing to the agent, right? Following 3 services are offered by the factor. One could be a debt collection and administration. So not only will they collect the debt, okay, that is, they will monitor, continuously follow up and collect it, but will also administer it. That is, all the age analysis they will do. They will take care of how much credit to be given, what amount credit to be given. They will do the credit worthiness, all of it. Okay. Now there are 2 types of factoring. One is with recourse, one is without recourse. If you say with recourse, that means if at all there is a default, if at all that account becomes a bad debt, it is the responsibility of the company. The factoring agent has a recourse with the company. Okay, so the company is liable. So recourse is where the company bears the risk of default. And the other one is without recourse, where the factoring agent does not have recourse with your company. So non-recourse, where the factor will bear the risk of default or the cost of bad debts, and thus it is more expensive. Then factoring agents will also provide with financing. That is, when they purchase those bills, they will say, okay, we have an invoice of $1 million. We'll give you $900,000. Okay, so they will provide financing. On that financing, obviously, they will take some interest. They also, if it is a non-recourse plan or service that you are opting for, then you are kind of getting an insurance from bad debts, because bad debts is no longer your responsibility. It is the responsibility of the factoring agent. So you kind of get indemnity from bad debts. So it's a credit protection or an insurance only when the service is non-recourse, right? So this is how factoring works. If it's just admin and debt collection, then company will sell to the customer. The company will sell the bill to the factoring agent. Now the customer has to pay the factoring agent, not the company, right? In invoice discounting, the customer was dealing with the company. Here, the customer is dealing with the factoring agent. The company is only just supplying goods, right? And then once the factor receives the payment, they will pay the company less whatever the fees they have. If there is financing involved, then the company sells the goods to the customer. The company will give the factor, send the bill, the invoice to the factor. The factor against that bill will provide financing, whatever 80-90% financing is given. Okay, the customer pays the factoring agent some amount. The factoring agent, with whatever amount received, would deduct any interest on that advance that they have given and reduce any fees, and balance amount will pay to the company. So, say for example, if the company has sold goods worth $100, okay, now they sold goods worth $100 through factor financing, they received $80 already. Okay, they are to receive $20 more that they will get after a month. After a month, when the customer pays entire $100 to the factoring agent, the factoring agent puts $80 in his own pocket and is supposed to give $20. But from that $20, will say on that $80 that I had given, there was a 10% interest or whatever interest is there. So that interest will be reduced. Plus, they have their own fees. So that fees is reduced. Say, for example, entire thing works out to be five. So $5 is again pocketed by the factoring agent, and the balance $15 is only transferred to the company. Okay, this is just one hypothetical example so that you understand it. It won't be that cheap, probably. Okay, the advantages of factoring is that you save on your administration costs. That is, you need not hire any employees and do all that. Uh, Again, it would be a team if you were to do the whole credit control at in-house, you would have a team doing it. So it comes at a cost. That's your admin cost, which you have saved. Reduction in the need for management control. So the management need not do all this credit control. Okay, management can focus on the more important things or can focus on growing the business. Okay, it is particularly useful for small and fast growing businesses where the credit control department may not be able to keep pace with the volume growth. They don't have huge teams, they are small, they want to grow fast, and it helps get cash quickly, thereby improving liquidity because factoring with financing, you get money also quick. A disadvantage is that it can be expensive. It could lose customer goodwill because the customer would feel that, hey, you can't even manage your own receivables. You have outsourced it to someone. Could maybe hamper your goodwill. May give a bad impression to the customers. Okay, customers may not necessarily want to deal with factoring agents, right? Because they know they are difficult people to deal with, in the sense that you have to pay them on time, otherwise their methods are a little difficult to deal with. Okay, the company may give up the opportunity to decide to whom credit may be given, especially when you're going for non-recourse factoring. The risk of default is in the hand is basically the factoring agent's responsibility. Okay, so the factoring agent will tell whom to do business with and whom to not, because the factoring agent is doing the uh, credit analysis. Okay, credit worthiness checks are being done by the factoring agent. They will ensure credit is given only to those people who have the capabilities of paying them back. If they feel that this person is going to default, they'll say, don't do business with this person. So you lose that control. Okay. So I think with respect to theory, we'll stop here. Right. Actually, there's payables also, but with the limited time that we have, we won't be able to do payables as well. We'll stop here and we'll do some questions. Okay, before we move on to the questions, let's take a quick 5 minutes break, and after that we'll do the question. Actually, not even 5 minutes. Let's just take 2 minutes break. I'll drink some water, and then we can continue. Right? It's a 2 minutes break. All right, welcome back. Um, I hope you're back. Okay, before we proceed, I I didn't realize there was a comment. Actually, I don't get those notifications over here, but somebody had asked for the previous session's recording. It's there on YouTube on the channel. If you just go through it, you will find it. This actually is day two. So there's only one session prior to this. Yesterday, uh, basically, there was no video out yesterday because I was unwell. Uh, so this is day two now, technically. So day one, it was exam tips, and day two is where we are discussing working capital, right? So I hope that's clear. And if you have difficulty finding that day one video, just go through the this thing, what you say, the recordings, right, on the channel. Now, just a moment. Okay, is this clear? Yeah, okay, the screen is clear. Right. So let us solve some questions, section C style questions. Now, I have picked up two questions from working capital. Now, it's not, both questions are not from receivables management. One is from receivables management, and the other one I have picked up is from cash management. Okay, because a lot of people skip cash management. So the easier parts like inventory, many people are comfortable with like EOQ is strong. They find it easy. Even in receivables management, the typical question they are used to is calculating discounts or cost of discount and then comparing. All of that is typical. I've selected two questions which usually students do not practice, or they have a tendency to skip it or ignore it rather. All right. So let's read question number one. Extracts from recent financial statements of Boulder Company are given below. Uh, so revenue, cost of sales, and gross profit is given to us. Gross profit is nothing but revenue minus cost of sales. Okay. And then we have our balance sheet over here. We have non-current assets, current assets, inventory, trade receivables. So before reading all this, because you kind of feel lost. Why is revenue? What am I going to do with revenue? What am I going to do with this balance sheet? So before reading the entire question, it's always a good idea to read the requirements. Okay. So our requirements, we are required to calculate the value of the factors offer on a with recourse basis, on a non-recourse basis. So I understand now that this question is from working capital, receivables management. It has to do with the factoring concept that we have studied. Okay. So uh, from a factoring agent's point of view, what all services factoring agents give us? They give us financing. They reduce our admin costs. They reduce our bad debts if we are with a non-recourse sort of thing, as in we get protection from bad debts. Okay. So all these are benefits. And what are the costs? The fees that we have to pay them. Right. So they have asked us to calculate the value of the factors offer with both scenarios, recourse and non-recourse. So probably four marks each. Comment on the financial acceptability of the factors offer and discuss the possible benefits to Boulder Company of factoring its trade receivables. Okay. So for 9 marks, they are asking us whether we should accept the factors offer, and we also need to highlight all the benefits of it. Now remember, in day one, I gave you a format how to write these. Shouldn't be one point. Over here, I've written it as point in the solution. When we discuss it, I've written it as point because I didn't want to write the whole thing. Okay. But you cannot write in points. You have to write a full sentence around it. We'll come to it a little later. Just keep this in mind. and discuss how the creditworthiness of potential customers can be assessed. Okay, we just discussed uh, all this in the theory. Both we discussed the benefits, we discussed the creditworthiness part also, how to assess it, right? You look at trade references, bank references, your competitors, published information, credit rating agencies, all those people you can take information from. Again, you just do not write these 1, 2 words. You need to explain, right? In one sentence. It's just 3 marks. So you can write 3 to 4 sources through which you can assess credit worthiness, right? And the other one is 8 marks. So where was it? Sorry, 9 marks. Okay. So you know that you need to probably there may be 2 marks for giving your decision, whether to accept or not. And the balance is for uh, the benefits. So accordingly, you should write, say, for example, if it's 9 mark, let us assume 1 mark is for our decision and 8 marks is for benefits. So we should write about 8 benefits. And if there are not that many benefits, then per benefit we write more content. Okay, worthy of an 8 mark answer. Okay, so now we have some sense as to what we are looking at. So we understand, okay, revenue is going to help us find the credit sales. Okay, it's going to help us find the, sorry, uh, from revenue now, maybe if there is a percentage of revenue, so we'll know how much is the credit sales. From cost of sales, we'll know our receivables because receivables will be valued probably at cost of sales. Okay, or whatever. Then gross profits. Then we have our current assets, non-current assets, inventory, trade receivables. So we need receivables. Okay, this is important for us, receivables. Equity, shares, all that thing we don't really need. Even non-current assets we don't really need. So other things we don't really need. Overdraft probably. Okay. A factor has offered to manage the trade receivables of older company in a servicing and a factor financing agreement. So here the factor is going to do both service the creditors as well as finance us, right? So the factor expects to reduce the average trade receivable collection period of Boulder company from its current level to 35 days. So whatever is the current level, we don't know, right? But this is something that is being given. So as you remember, in day one, I had suggested for type C questions, make a financial summary. So if you have 35 days given over here, quickly on your spreadsheet, copy this 35 days and write it over here. So reduce receivable days after factoring is 35 days. Okay. Do we know the receivable days? Currently, no, it's not given yet, as in we need to calculate it. So we are not writing that now. Here we are just mentioning things which is given. So reduce receivable days, 35 days. To reduce bad debts from zero point 0.9 to revenue, sorry, zero point 0.9 of revenue to zero point 0.6 of revenue. So after taking factoring services, okay, since they are giving service as well, their credit checks are better and due to which has resulted in a drop in bad debts to 0 0.6. So earlier it was 0 0.9, now it has become 0 0.6. Of what? Of the revenue. Okay, so we write that now. Previous bad debts was 0.9% of revenue and reduced bad debt, that is after factoring, it has dropped to 0.6% of revenue. That means 0.3% less bad debts. So savings in bad debts or benefits due to reduction in bad debts is 0.3. Is the savings that you are doing. So it means that out of $100 sale, okay, say 90 cent was lost previously, but now only 60 cent is lost. That means you are gaining 30 cents. That's your benefit. Um, yeah. And to save Boulder company for 40,000 per here in admin costs. So 40,000 is the admin savings. So you write that also. Admin costs save $40,000. Now remember, in your exam, all these informations will be given on your left hand side. On the right hand side will be your spreadsheet. So it becomes very easy for you to do a quick copy paste and write these things down, right? You need not keep scrolling up and down and start searching. You can just look at your left hand side, right? Note these things on your right hand side. Copy paste functionality is available to you. Need not type all these things, right? So where were we? Yeah, 40,000 in admin costs. Sorry about that. Getting a little stressed on the throat. All right. Where were we? Yeah, the factor would also make, yeah, 40,000 we discussed. Factor would also make an advance of 80% of the revised book value of trade receivables. So whatever the new trade receivables would be, 80% of that will get funded by the factor. So we write that also. Okay. Then the interest rate on the advance would be 2% higher than 7% that Boulder currently pays on overdraft. So we know that the overdraft rate is 7% and the factoring agent is going to take 2% extra, right? So bank OD is 7%, additional interest charged by factor 2%. So totally factor agent is going to charge 9%. The factor would charge a 0.75% of revenue as fee on a with recourse basis or a fee of 1.25% for a non-recourse basis, right? So 0.75 with recourse, 1.25 without recourse. Percent of what? Of revenue. Okay. Assume that there are 365 working days in a year and all sales and supplies are on credit. That means all of this 100% is credit based sales. Nothing is in cash. Okay. We are asked to calculate the value of factors offer on a with recourse basis, on a non-recourse basis. So we need to do, and then we are asked to comment whether we should accept it or not. Okay, all this information. So now you have the financial summary with you over here. Whatever you need, you can easily cell reference it. And like a snapshot is just very easy. Like it just makes your uh, answering process very simple, right? So now you can just quickly see what all we have. We have receivable days. Okay. Uh, that is after factoring. But before factoring, we do not have the receivable days. We have bad debts before and after. We have costs. We have a cost save, that is rather. Okay, we have how much financing is done. We have OD, we have additional interest, we have factor fee in both the scenarios. Okay, what we do not have is how much does my new receivables become. We have reduced receivable days, we have old receivables. Over here, we have trade receivables. We don't know our new receivables, so we need to find that out. Okay, we need to find the old days probably also if required. Let's see. So current credit sales, we write down the entire amount that we had. Now keep in mind all these are in $1,000. Okay. But a lot of these figures may be in millions. Uh, so we could either continue it as $1,000 or we could switch it to million. Now I'm switching it to million to avoid any confusion. The highest denomination. Okay. So the credit sales is $21.3 million. The current receivables taken again from the information available, $3.5 million, right? New receivables. Now for new receivables, we had our formula. So what is our new receivables? It is new receivable days, 35, divided by, we are being given, it should be 365 days, into credit sales. the current credit sales. Okay. So right, that is how you would calculate your new receivables. So I've already done the calculation. I'm just showing it to you. Right. So nothing. It is the receivable days divided by 365 into your current credit sales or the relevant cash flow. Okay, so credit sales. We are valuing our receivables on sales. We value our payables on cost of sales. Okay, so yeah, your new receivables have been recorded. Now reduction in this receivables. Okay, how much are you reducing? It's just minus these two. So previously your receivables were 3.5 mil. Now it's reducing to 2 mil. So that means you are reducing your receivables by 1.45 or $1.4 million. Right? Since receivables have reduced to $1.4 million, on that, whatever financing you had to do. See, previously you had to fund for 3.5. Now you are funding only for 2. So what is your saving? Your saving is the funding cost of 1.4 million. So savings in finance cost. Now remember, this is OD. Normally, you would, if you were not doing any factoring or anything, you would have taken an OD. OD at what rate? 7%. But now you need not take that OD of 1.4 extra. Okay, because you are saving that. As in your receivables are reducing by that much. So it's not required. So now you have only a $2 million outstanding. It's reduced by 1.4. So only on that amount you are going to calculate the interest saved. So you will take this into how much interest was there? 7% per annum. So you are saving $102,000, right? We have done everything in millions. So this is not $102,000. This is just $102,000. All our main figures are in millions. So these are proper denomination. That is why I prefer. Otherwise, you would get something in decimal, and that won't be the correct answer in the sense that, say, for example, you get $102. That's not, you are not kind of saving $102. You are saving $102,000, right? That is why I prefer writing everything in millions to begin with. So the savings is $102,000 just from the OD that you did not have to take. Then admin cost saving is already given to us clearly over here, $40,000 admin costs, and bad debts reduced. Okay, now remember, we are looking at the benefits only. So we are not taking that, oh, with factoring, what is my funding cost? No, because funding cost is actually 7 plus 2, 9%. We're not doing that. We are just doing a comparison that if I did factoring, I would not have to take 1.4 million as OT. So I am saving there. If I had not, sorry, if I had taken a factoring, then I am saving admin costs. If I had taken factoring, then my bad debts will get reduced by, okay, it is reduced, not reduced to, it is reduced by 63. So that is the difference between 9 and 6. Okay, so you will say how much is my bad debts reduced by? You will say previously it used to be zero point 0.9. Now it is 0.6. That means it is only 0.3% of what? Of the revenue. What is my revenue? 21.3 million. So $63,900. And I would just add all of this up and will find my total savings. So if I do factoring, I will save on my funding costs in ODs. I will save admin costs. and I will save on bad debts, right? Remember, not 0.6%. It is the savings, right? From zero point 0.9, it drops to zero point 0.6. So how much have I saved? 0.3 only. That's one common mistake students would make in a hurry. Now, these are the benefits. Okay, so I've made this in bold that the total savings from factoring is $205,000. Now, cost of factoring. Now, this is with recourse, all this scenario. I have to pay a factoring fee. How much is that fee? It's already given. It's 0.75% of revenue. So 0.75, and this is the revenue. So I have my fees, and I need to pay interest. Okay, now what is the extra interest? See, if I would have gone with OD, I was paying any which way 7% interest. So what is that additional cost or the additional interest, right? So the additional cost is 2%. So I am whatever my receivables is, the new receivables. Okay, now 80% of the new receivables are being funded. So into 80% into that additional interest charge 2%. So very simple. Just have to say that what is my current, because remember the financing is not on sales, total sales, it is on the receivables. Okay, the amount that you are to receive not immediately but after a month or whatever it is. So my new receivables is $2.2 million into, I'm not getting the entire thing as funding, I'm getting only 80% of it, into what is the extra interest. I won't do 7 plus 2 9%, that is total interest. I am just comparing with that. If I do factoring, how much is the extra I have to pay? This 2%. So 32,679, right? If I do factoring, I'll have to pay a fee. If I do factoring, I have to pay extra interest. If I don't do anything, and I don't pay anything, as in I would just be paying bank OD. But since I'm factoring, I need to pay these two. Since I'm factoring, I'm getting a benefit on saving some OD. I am also saving. Again, do not do the entire amount because you are funding it. You are just saving on the reduction in your receivables. Okay. So that savings, admin costs saved, and the bad debts that you have reduced. So these are your savings because you did factoring. So your total savings or total benefits, your total cost, just minus the two, and you will get net savings. And you see it's a positive figure. That means your savings are more than your costs. That's a good thing, right? Now you could just literally do a copy paste of whatever is written above below. Okay. That's the benefit of using a spreadsheet. You need not type down everything because your credit sales would remain same, your current receivables remain same, new receivables, reduction in receivables, everything remains same. Only thing is this is without recourse. That means that the responsibility of bad debts is with the factoring agent. Basically, in our books, we have an insurance against bad debts. That means, so though it's not explicitly given in the question, it basically means that if we go with recourse, sorry, if we go without recourse, that is non-recourse, then there are no bad debts. So this previous bad debts becomes 0.9%. And if I had to write this, okay, let me just put it over here. After non-recourse, okay, after non-recourse will become 0% of the revenue. Let me just extend this. This is after with recourse. factoring. All right. So this wasn't explicitly given in the question. It is understood that, oh, since it is since there is no recourse, that means we have full insurance from bad debts. Bad debts is no longer our responsibilities. It is the headache of the factoring agent. For that, we are paying extra, right? That's the only difference between with recourse, without recourse. So the only thing that changes is bad debts component. Savings would remain same, admin costs saved would remain same, only bad debts will get reduced to 0%. That means entire 0.9% you are saving. Where is it? 0.9%. Sorry about that. Sorry for my low energy and my voice. I just trying my best over here. Right. Anyways, so yeah, I just highlighted that. You need not highlight this. You could just highlight this so that the examiner knows, okay, net savings on factoring with recourse is this much, and net savings on factoring without recourse is this much, and your final conclusion is highlighted. Okay. Anyways, coming back. So I've just highlighted this one for you. That bad debts is the only differential. It's more savings on bad debts because it's reduced to 0%. All bad debts, there are no bad debts anymore. Everybody, you get money off everyone. So that's your total savings. And against that, you have to pay a higher fee. All right. So on your receivables, sorry, on your sales, you are paying 1.25%. That's your fee, 1.25% of revenue. Revenue is 21 billion. Okay, so you are paying higher fees. Financing remains the same because financing is done on your creditors, your receivables. Okay, so receivable amount doesn't change, right? So factoring fee, that is the additional interest you are calculating, remains the same. So your total costs are slightly more. However, the benefits are much more than the costs. This should be bold. Yeah. So $34,000 is what you are saving by factoring with recourse. Whereas in the previous scenario, you are saving only $13,000. See, in both scenarios, you are saving, but it makes more sense going with this. Okay. So, in your conclusion, you write the entire observation that is given the above information. So, write that given whatever is provided in the question below, whether it's estimates, because we don't know for sure, right? What will be the sales? These are all expected sales or expected receivables, all of that estimates. So, given the above information, so we start our question that, we start our answer that way, that given the above information, both the factoring, that is with recourse and without recourse, seem to be financially beneficial as there is a net savings in both types of factoring. The savings of factoring with recourse is $13,000, and the savings of factoring without recourse is $34,000. Thus, we would recommend recourse factoring as the financial savings is more despite a higher factoring fee. Okay. Then they asked us for the benefits. So management can focus on business operation. Management need not uh, be bothered by credit control responsibilities. Okay. So we write that. So the management can focus on business operation such that so that they can expand quicker or give better customer service. You could complete that entire statement. Okay. For example, then you can, if you want, you can give example. For example, the management now need not spend time or utilize that time to follow up with the customers, right? Instead of daily 1 hour calling the customer up and saying you have to pay, you have to pay, you have to pay. Instead, that 1 hour could be spent in other productive tasks, right? So management can focus. So this is how you write the point, that how are they or why are they able to focus on business operations better? Because they need not spend time following up with customers. They need not spend time in credit control, credit worthiness checks. Okay. Or they need not. So you could write management can focus on business operation better because they need not spend or devote attention to credit control activities. For example, they need not follow up. They need not spend time following up with customers. That's your entire point. Okay. Expertise of the factor agent in credit management. So why are factor agents expert in credit management? Because this is what is their focal. This is expertise of the factor agent on credit management because they are into the business of credit management and they are better and have more experience in credit management or credit risk management than us. What is our business? Our business must be something else. They haven't spoken about the nature of our business, but it's something else. It's not recovering money from receivables for sure, which is the business of factoring agent. Then we get an insurance against bad debts as in non-recourse financing, sorry, non-recourse factoring. The responsibility of bad debts is taken over by the factoring agent, and there is no recourse and they do not have any recourse with the company. Full thing. Okay, then you can give, for example, if there is a default, the responsibility or that is irrecoverable debt, the it will be borne by the agent and not us. You can give one example that way. Factor financing, we get financing also from it, so we need not approach a bank and give them some what do you say collateral. Nothing. You have a factoring agent, they are also providing you with financing, so that is going to help improve your liquidity as well. And admin costs are saved as you do not have to hire a team and pay salaries to a team that takes care of credit control, okay, or manages the credit risk. So all these are the savings. So you do not write it in bullet points this way. You elaborate, give examples. All of that I've discussed in day one video. This is day two, right? So this is on factoring. Question two, as I said, is on is again working capital, but from cash flows. Okay, cash is another important current asset. So, like we first read the requirements, so we get a sense as to what we are finding. Using the information provided, prepare a forecasted statement of financial position for Pumis company. So we need to prepare a statement of financial position. That is a balance sheet we need to prepare, a forecasted one. Calculate the effect of proposed expansion on working capital ratios listed by the finance director. So I guess there's some expansion happening and we need to calculate certain working capital ratios as well. Discuss the ways in which implementing the proposed changes in working capital represents change in working capital investment policy for Pumis and changes in working capital funding policy for Pumis. So we need to speak about the changes in the uh, investment policy as well as funding policy. That is, whether we fund it through current assets or long-term assets. Let's see. Let's see. There is something about the policy we need to comment on. Okay. Now we read the question. So we have some idea that, okay, majorly we have to create one balance sheet again based on the forecast. Puma's company plans to expand its business operations by opening several new outlets at a cost of $8 million. So write down $8 million. So you'll write down that investment required is $8 million. Financed by an issue of loan notes. So we can write basically that $8 million new loan is issued worth 8 million. So basically your liability is going to increase by 8 million. Okay, so you write that down. Funding by loan note $8 million. So you see, what do I mean by writing a financial summary of a question? Whatever figures you get, except for these tables, you just write it down. Because tables you can clearly see. You need not search for the figure, right? The company currently generates a credit sale of $80.768 million before the cost of sales of 27. So we have sales 80.7 and we have cost of sales 27.7. Again, we write it down. Okay. Then they have given us the balance sheet. So we have our assets, non-current asset, non-current assets, current assets, which includes our inventory, trade receivables, cash and cash equivalents. This is the total current assets. These are our total assets. Then we have equity and liability. So equity reserves are given. Then we have, therefore, we know our total equity. We have our liabilities given to us. We have current liabilities available. And then we have the total equity and liability. So it kind of matches. So assets and liabilities are equal. Puma's company expects that the expansion will increase credit sales by 18.7%, with cost of sales being 33% of credit sales, and the profit after tax being $6.818 million. Okay, so profit is given 6.818. They are saying credit sales is increasing by 18.7, and whatever that increased sales is, their 33% is the cost of sales. So we can write all these things down. Okay, so we know that after expansion, increase in sales is 18.7. Cost of sales as a percentage is 33. Profit after tax is 6.81. It's easy to calculate it, but hold on, we are just reading the question. We are not getting into calculations. We are just writing the financial summary or reading the question rather. The bank has demanded that Puma's company's overdraft be reduced to 3 million, and the company expects its cash balance to be $700,000 after expansion. So they have given that cash will be $700,000 probably when we are making our see over here cash and cash equivalents. We are recording it as $700,000. Okay. Then what else? Uh, Yeah, our overdraft needs to be reduced to 3 million. So if in our current liability we have overdraft, yes, we do. So it reduces to $3 million. Remember, all these figures are in $1,000. So therefore, I've written it as 3,000. So that, many times you would just like 3 or 3 million, but remember the heading says $1,000. Accordingly, you need to adjust it, right? Um, what else? Where were we? Yeah. Again, as I said, the questions for you all will be on the left hand side, and it's easy left and right instead of scrolling up and down. Puma's company has been receiving complaints about its suppliers about late payment. So clearly, there seems to be some liquidity based issue with Pumas. Probably it's not even paying its overdraft facilities on time. Therefore, the bank has reduced their limit. Okay, the liquidity position has been reduced, and the suppliers are also complaining about late payments, and the company plans to improve its working capital management as part of the expansion. The company is expanding, but there is a liquidity issue. They are trying to address it by improving their working capital. Now let's see. Inventory, so it expects that the following working capital ratios will result. So this is after expansion or after whatever efforts they are taking. They are expecting that the future inventory days will be 50, Receivables will be 60 days and payables will also be 60 days. Okay, so if you want to think of a it's not us, but if you just want to do a quick cash conversion cycle, you know that you're getting your money after 50 plus 60, that is 110 days minus 60. So that's basically within 50 days, you're getting your money back. The finance director of Pumis company wishes to investigate how the expansion will change the following ratios. They are interested in trade payable payment period. That is, in how many days are we paying our suppliers? They want to check. They want to check the current ratio and they want to check revenue divided by net working capital ratio, which is defined as net working capital as inventory plus trade receivables less payables. Okay, so they have defined how net working capital needs to be calculated. So you take inventory plus receivables minus payables. So you're not taking overdraft. Okay, and what other things you have? You're not taking cash and cash equivalents, you're not taking overdraft. Okay, so they have explicitly defined it for you. Otherwise, normally you would take these two. Okay, assume there are 360 days in it. Prepare a forecast. So let's prepare. We have all these things we have written over here. Okay, non-current assets. So we have written everything like this much we had already with us. Okay, now understand that we are expanding. So for expansion, we have expanded worth 8 million. So whenever we expand, we buy non-current assets. So we are increasing that by $8 million. Or sorry, it was written that net current non-current asset increased by 11%. Was that given in the question? Did I miss it out? I don't remember. Yeah, non-current asset will increase by 11%. Okay. So, or else we could have assumed that that 8 million is going to fund the entire expansion. That was an assumption that I made. But anyways, it's been given explicitly. So we can take the 11% growth in non-current assets, right? Then moving on to current assets, inventory. Now, what information do we have on inventory? We have inventory holding period, 50 days. Okay. So from holding period, if you want to find inventory, you will take the holding period, that is 50 days, divided by 365 into the relevant cash flow. Okay. So cost of sales in this case. So it's, or was inventory given? C87. Oh, okay. There is a working note that I've made. Yeah. So here we are doing that only. We are taking our cost of sales, uh, as in 360, our days divided by 360. They have asked us to take a 360 day, not 365, into our cost of sales after expansion. So that's how we get our inventory. I've written the formula also over here. In the exam, the formula will not be given, but you do not have to write this. Okay, you could just skip this row altogether. This is just for you that I've written. Okay, so in our working note, we know the current sales. We know the sales after expansion because we know that how much it was growing by, and we know that 33% of that sales will be cost of sales. So all these three figures we have found out, right? We have our inventory 4.39, which we wrote over here, 4.39. Then trade receivables. Again, we have old one. For the new one, we have receivables days. So with that receivable days, the relevant cash flow is sales. So we can find our receivables. That is receivable days divided by 360 into sales. Okay, so 15.98. So we write that 15.98. Then we have cash and cash equivalents. We had discussed earlier that it's given 700,000. So we write somewhere it was. Okay, I think we didn't write it. Yeah, yeah. Yeah, it's 0.7 million, which is equal to 700,000 $1,000. Okay, so don't get confused. Remember, everything is are in $1,000. Okay, so yeah, sorry. So $700,000. So our assets are prepared. We add everything up. We find our total assets. In case of equity, well, the funding or the expansion is not done through equity, so equity remains the same. Okay. In reserves, like whatever your profit after tax entirely will get transferred, because nothing about dividends has been mentioned, so we can kind of assume that. So where is our profit after tax? $6.818 million. So that will get added. So if you see the previous reserves, to that you will add the profits earned, profit after tax. You can write, we assume that all profits are transferred or are retained. Okay, no dividend is paid. You assume that. So total equity you get. Non-current liabilities, we checked that we are to take a loan of $8 million. So this into that $8 million loan that we took. Okay. Trade payables, well, old is available, new we can use payable days and find out. So we are finding payable days, that is, we already have it in the question, divided by 360 into cost of sales. Payables again are valued at cost of sales. Okay, so 5.27 million. So you have your trade payables. Overdraft, they explicitly mentioned that the limit drops to 3 million. So you're putting it at 3 million. We are assuming that it is utilized. So yeah, that's how, and you can just do a quick check whether it tallies. Yes, it tallies. That means everything you are doing is proper so far. And your note, due to absence of any information, just a moment. That thing is getting covered, right? Wait. Okay. Note, due to absence of any information, we assume that no dividends are paid. Thus, the entire PAT goes into reserves. Right? And our working notes. We just saw. So clearly label solution for question A, part 1. The question 2 should be question 2, A1, because this is subsection A, subsection 1, wherein prepare the report. Then subsection 2 asks calculate the effect of proposed expansion on working capital ratios listed by the finance director. The finance director has mentioned certain ratios, which are payable days, current ratios, and sales by net working capital. Net working capital they defined for us. Okay, so payable days, so we already have for after expansion, but we don't have before expansion. So before expansion, we calculate, that is, we'll take our credit sales in divided by your how you are valuing payables at, it's on cost of sales. So you will take current uh, trade payables divided by your cost of sales, which is 27.7. Okay, now this is million, so you are multiplying it into thousands. Okay, into 360, right? So that will give you your current trade payable. Whereas in this case, it's already given, 60 is already given in the question. So it's simple. It's just whatever formula you used over here, it gets rearranged. So for payable days, if you want to find payable days, you will do cost of sales divided by payables divided by cost of sales into 360, right? So if you had to do that, um, so over here, We will take cost of sales, that is D84. Okay, payables. So if we have wanted to find, we'll take payables. Wait, where is payables, payables, payables? So payables divided by cost of sales into 365. Now, if you just do this in a hurry, you will get it wrong. Why? Because these are in thousands. Okay, these are in thousands, whereas these are in millions. So you need to convert that million into thousand or the thousand into million. It's up to you. So let us do like convert millions into thousands. So you are putting a bracket to this into thousand. Okay, because you need to have a bigger figure, right? It's not 27.7 is million. In thousand, it would be 27,700 something thousands. Okay, so 128. Now these are days, not what you say. Why am I getting 128 here but 126 years? Everything is same, right? E74, E43, E74, E43 and 2000 and 2036. Okay, I took 365 days. Sorry, my mistake. 360 days. In the question, it's clearly explicitly given that take 360 days in a year. So we take 360 days. Okay. So 126. Now, these are not dollars. These are days. Sorry, these are not inventory days. These are paper days. Okay. So you see, you can do copy paste functionality. You need not keep typing things every now and then. Right. So 126 drops to 60 days, which is it's kind of like they are trying to pursue making that half almost. Okay. So the company is targeting a 60 days, a reduction of 66 days. This looks very ambitious. So highlighting that to them. Current ratio is current assets divided by current liability. So we can find that for both the years because we don't have it available. So we calculate that. It's very simple. CA by CL. Okay. So your current asset is here, current liability is here, and then you do it for both days. Okay. So typically they say that your current asset should be twice that of your current liability. In this case, previously it wasn't, but now it is improving. So you can say that, yes, my liquidity seems to be improving. This suggests that the company is looking to increase solvency, okay, or liquidity. And the last ratio they wanted was sales to net working capital. And net working capital also they defined that in the assets you will only take inventory and receivables, you will ignore cash. And in liabilities, you are going to take only payables, you are going to ignore overdraft. Okay, so that's it. You just have to take your assets, that is inventory, plus your, sorry, how had they defined it? So it's revenue divided by your net current assets. So revenue is 242, sorry, revenue is 80.768 million. That's the current sales divided by the asset. So your inventory plus your receivables, inventory plus your receivables minus your liability payables. Okay. So the custom formula has been put in 12 and 6.35. That means here your working capital was generating 12 times sales. That means you were over trading, could have gone insolvent any time, could have defaulted any time. Now there is improvement. Okay. There is less strain on your working capital. There would be a substantial increase in capital supporting revenue. in the sense now your long term capital is supporting the sales. Previously, all your current assets were supporting, or the current, what do you say, net current asset, which is working capital, was resulting in so much sales. But now the burden on the working capital has reduced, become half. Okay. Anyways, these comments were not asked, I guess. Just written it. Um, the requirement, calculate the effect of proposed on working capital. Yeah. Now they ask us to discuss the ways in which implementing the proposed changes in working capital represents a change in working capital investment and changes in the working capital funding policy. Okay, so then you can just write. Now we haven't discussed this theory, so I'll just read through changes in working capital investment policy. So see how headings are given, right? A proper heading is given. You can make this bold. That working capital investment policy considers the level of current asset used to support the revenue generation in relation to different companies. A company adopts an aggressive working capital investment policy relative to another company if it uses lower level of current assets to support a similar level of revenue generation. So I'm sure you know aggressive, conservative approaches. Okay, conversely, the second company adopts a conservative working capital investment policy relative to the first company. While there are no companies here with which to compare. Then, so we are first talking about both the policies, aggressive and conservative. In aggressive, the sales are sales to current asset ratio on the higher side. Okay, as in you are using less current assets but more sales. Like if you see this seems aggressive, okay, but this is slightly less aggressive. It's not conservative by any means, it is slightly less aggressive. Okay, so here we are saying there is nothing to compare, so we don't know whether it's which one is aggressive. But while there is no companies here with which to compare Pumis company's working capital investment policy, the effect of implementing the proposed change in working capital can be measured by revenue to current asset ratio. This shows that no significant change has occurred as a result of implementing the proposed changes in working capital, as it has only changed from 4.72 to 4.55 times. So your current assets as such, I guess, are not changing with in line with your revenue changes. Let's see. So how are they calculating these ratios? How are they getting 4.72 and 4.52, 55? It's simple. You just take revenue. So old revenue was what? So old revenue divided by current assets. Okay. Is this not coming? Oh, wait. Revenues were in millions, right? Yeah. So see, easy mistakes. So 4.72, right? And then you will say that this was earlier, it was 4.72. Currently, it will become new revenue. What is our new revenue? Sales after expansion is 95.87. Okay, but it's in $1 million. I need to convert it. Okay, this divided by my new current assets. My new current assets are 21. So that means my working capital, as in my sales to current asset ratio, has not changed much. So even though I have implemented a new policy, I am still aggressively trading it. Okay, there isn't any change. Revenue by current asset appears a less sensitive measure of working capital investment policy than revenue by to net working capital. So that's what I was comparing at first. I was looking at this, but you could look at both. However, this ratio is a better ratio. Okay, because you are also considering liabilities. However, they have a modified version of net working capital given. The director has modified it. Okay, therefore it is 12.8. We aren't taking cash and we aren't taking. See, over here we took cash. If you see over here, we took the entire inventories, trade receivables, and cash. All of this adding up becomes 17. All of this adding up becomes 21 million. Okay. So 12 and 6.35 times as a result of decreased reliance on short-term working capital funding implicit in the proposed change in working capital. Okay, so you are showing that. And part two, that is change in working capital funding policy. Very similar, that how are you funding the working capital by long-term liabilities or short-term liabilities. So working capital funding policy can be characterized as a conservative, matching, or aggressive approach depending on the extent to which the fluctuating current assets and permanent current assets, I hope you remember fluctuating and permanent, are financed through short-term or long-term sources. A conservative funding policy will use long-term funds to finance permanent current assets and a portion of fluctuating current assets. This is a lower risk policy as long-term funds are less risky than short-term funds from a company's perspective. But as long-term funds are more expensive than short-term funds, this policy also decreases profitability. Okay. In conservative, you are opting for a more stable source of funding, that is long-term source of finance. But long-term source of finance is more expensive. So therefore, your profitability will get sacrificed, but at least you are having what you say, liquidity. Because you need not see, if you take a working capital loan, you may have to pay it within 6 months, within 1 year. If you take an overdraft facility, you have to pay it within a month or on demand, basically. Okay. But if you have a loan, it's for 5 years. So you know that you have money, you know there is liquidity. Okay. But the risks are higher, therefore the cost will of long-term funds are higher. Short-term, on the other hand, are less riskier loans and therefore they attract lesser interest rates. Okay, so we need to fund our assets. Now we have two types of assets, current assets and non-current assets. Non-current assets typically gets funded by non-current liabilities. Current assets we can bifurcate into permanent current assets and fluctuating current assets. Permanent current assets are those current assets, it's like fixed. That this much sort of inventory we have to maintain if we are targeting the X amount of sales. Okay, so it's part of your, at any given time, you will have this much in your inventory. So it's like a permanent current asset. So a permanent current asset, if you are funding it with long-term liabilities, makes sense. And a portion of fluctuating, if you are doing also long-term assets over there, funding as in long-term liabilities over there, that is non-current liabilities, you are funding that fluctuating current asset with non-current liabilities, then that is conservative. But if you are if you are funding it with short term, okay, an aggressive funding policy will use short term funds to finance both fluctuating current asset and a portion of permanent current asset. So you are taking more risk. In the sense, you are being more aggressive. Why are you being more aggressive? In what sense? You are chasing profitability. So it is like, for example, let me give you one example. Okay. Say labor. Now, labor, certain amount of labor would be permanent, certain amount of labor would be fluctuating. So whatever is fluctuating, you are funding it through short-term loans. Okay. But whatever is permanent, you know that you have to pay monthly salaries or monthly something. Okay. And ideally, you would want to have like a 5-year loan to fund this to help you with the liquidity. But you have taken a short term funding. Like, say, for example, you are funding your permanent current assets through something like payables. Okay, so now payables, your vendor has given you 10 days and say 30 days. Let's be a little more realistic. So your vendor has provided 30 days credit and you have provided a 30 days credit to your customer. Now, if your customer defaults, you still have to pay your supplier, right? So you will have a liquidity based issue. Or if you're funding it through an overdraft facility, your overdraft facility is funding your receivables. You were to receive money $1 million in 1 month time. You did not get that money. You took a 1 month overdraft, or the bank demands within 1 month, please pay me $1 million. Or you took a working capital loan or a short term loan or whatever. You have basically borrowed $1 million for 1 month. Your banker is going to call you up after a month that, hey, listen, you had to pay $1 million. You would say, oh, my customer didn't pay. And on an average, you will always have $1 million minimum. If you do more sales, if there is how we have a Black Friday sale coming up. So that's in a particular month of November only. So only in November would you see a spike in sales. But on an average, so that's your permanent receivables. And then there is something fluctuating when you are doing promotions or something. So since you are doing promotion, your sales would increase. Your sales would increase your current liability, your current receivables. So receivables will basically increase, right? But 1 million at any given point of time, you will have that as your receivables. This particular person has not paid you on time, you will default. That is, but why did you do this? Because a working capital loan is cheaper than a 5-year loan. So what you are chasing profitability, but at whose compromise? Liquidity. Okay. So an aggressive funding policy will use short-term funds to finance fluctuating current assets and a proportion of permanent current assets. This is a higher risk policy as short-term funds are more risky than long-term funds from company's perspective. But as short-term funds are cheaper than long-term funds, this policy will increase profitability. And matching is where you match it. In the sense, all your permanent is taken care by long-term and fluctuating is taken care by short. Matching funding policy would apply to matching principles in using short-term funds to finance fluctuating current assets and long-term funds to finance permanent current assets. Okay, so you mentioned all the three policies. Now, while there is insufficient, now you are relating it to the case. While there is insufficient information to determine the relative levels of permanent and fluctuating current assets, implementing the proposed change in working capital shows a substantial movement to using long-term funds rather than short-term funds because your OD dropped, your loans increased. Before the expansion, 77% of the current assets were financed with short-term funds. That is trade payables plus overdraft. After expansion, only 39% of your current assets were financed for short-term and 61% was financed from long-term funds. This change is also apparent in the increase of the current ratio from 1.3 to 2.55. So you can see that what is current ratio? Current assets to current liability. So the proportion of current assets improved. Okay. Or you could say the funding by current liabilities have reduced. More funding is done by long-term liabilities. Okay. To be precise, Before expansion, 77%. How do you find that percentage? It's very simple. You will take this divided by your total assets. This is 77%. Okay, and now it is just 39% after expansion. Okay, wait, it got, yeah, I think it's visible now. Yeah, visible. Great. Okay, so 77% previously was, and now it's only 39%. Okay. And if you had to see how much of non-current liabilities is funding, you would have taken this, or rather, you would say that no, because see, these liabilities are going to fund both the assets, as in non-current asset as well as current assets. So therefore, it was coming more like your requirement is just 17, but $18 million loan. Okay, so it's over and above that. But you would say that since 77% is funded by liabilities over here, current liabilities, that therefore your non-current liabilities is just taking care of 23% and 61%, or rather percentage of current asset funded by current liability and funded by non-current liability. Okay, clear? Great. So yeah, I think that brings us to the end. Wait, let's just complete this, reading this. So the proposed changes in working capital therefore suggests a movement by Pumis company from an aggressive working capital funding policy to a more conservative working capital funding policy. This view is also evidenced by the decrease in short-term funds relative to what it was before. The $3.9 million increase in current asset and a $14.8 million increase in long-term funds. The company's current reliance on short-term funds have been reversed. Okay, these are all the calculation that you needed to do for finding out 77%, 39%, and all those figures which is mentioned over here. Okay, so I hope everything is clear. With this, we are done for the day. Next session, that is day 3, we'll be doing another topic. I think we are scheduled to do business finance. Okay, and then we'll at the last day 4, we'll be doing our investment appraisal, and day 5 we'll be doing one mock. Okay, so I'll see you tomorrow. This is me, Paritosh Panchal, signing off. I hope I was able to add value to you today. Thank you so much for attending. Thank you for your time. Have a great day ahead and all the best for the exam. God bless you. Bye bye.